Hello, my name is Remington Tonar. I'm the managing director of the Cannon, Houston's largest startup support organization. And today I'm going to be talking about startup funding strategies and fundraising best practices. But first, I just wanted to congratulate all of you on your entrepreneurial journey. Joseph Schumpeter, the 20th century economist who founded the study of entrepreneurship, once wrote that the function of entrepreneurs is to reform or revolutionize the pattern. And indeed, that is what an entrepreneur does. They reform and revolutionize patterns, they disrupt status quos, and ultimately transform society for the better. Today, we're going to be talking about a number of things. Here's the agenda. We're going to very briefly discuss the evolution of startup capital. We're going to look at the regulatory environment, which is very important. That stuff can be extremely dry and boring, but when you're raising money and when you're looking at the different alternatives for venture capital, it's extremely important that you know the legalities behind those sources. We're going to look at those sources as well as the types of funding instruments that those sources use. And then very briefly discuss the future of venture capital, and then finally discuss some best practices and other resources for fundraising. So very quickly, just a quick disclaimer. This document is for informational and educational purposes only, and nothing in it constitutes or should be construed to constitute legal or financial advice. You should absolutely consult a lawyer or registered financial advisor prior to taking any action based on the information contained in this presentation. And then all non-original content is the property of its owners as indicated in the source citations in the document and are here used without permission for educational research and commentary purposes as fair use as defined under the U.S. Copyright Act. Very quickly about me, managing director at the Cannon, as I mentioned, Houston's largest startup support organization. Prior to that, I spent several years in New York City as a practice area director and senior consultant working in innovation and growth strategy, mostly with Fortune 100 clients. I've raised a micro VC fund focused on early stage food and beverage CPG companies in the past, and I've helped raise around 30, that number is about closer to 40 now, million for startups across industries in the last 7 years. And I've spoken on this and similar topics around the world, from New York to Rome to NASA Johnson Space Center, and have graduate degrees from New York University and Loyola University of Chicago. So very quickly, the evolution of startup capital, where does it come from? So venture capital, sometimes called risk capital, is a form of private capital investment, which is to say it's not publicly traded, that provides funding to early and earlier stage ventures with high growth potential. And the aim, of course, is to generate higher returns for accepting the higher levels of risk associated with unproven or risky opportunities. Interestingly, venture capital, the roots of venture capital, go back thousands of years. As early as 2000 BC, wealthy families in some of the ancient empires at the time were known to have invested in trade expeditions and formed trade partnerships to mitigate risk. So they would invest in explorers who would go off and try to find new towns in different parts of the known world to trade with. And that, of course, was an early type of risk capital. The 18th century BC, banks emerged and supplied most of the capital through debt, or what is now called debt. And since the concepts of private property and equity didn't exist back then, there was no demand during that period for what we now call venture capital. But fast forward to the 16th to 18th centuries Common Era, trade expeditions during the mercantilist period were funded by nations and citizens who bought shares in various ventures, which is more akin to public equity or the stock market in buying shares, but it did kind of start bringing back the idea that you could own a piece of something risky. And then in the 19th century, as Harvard business professor Tom Nicholas argues, the whaling industry actually becomes really the first industry to have a structure and an intention similar to what we now call venture capital. Very interestingly, if you look at Venture capital structures versus whaling structures. They're very similar. You see that on the left. And on the right, you see the return distribution of venture capital funds and whaling expedition funds are very similar. So, and this can be found in Tom Nicholas's book, VC, An American History, where he kind of talks about the similarities between venture capital and whaling. Kind of an interesting historical fact there. Venture capital is more important than ever. Since 1979, among publicly traded companies, 43% of all publicly traded companies were or are venture-backed. That comprises or constitutes 57% of the total market cap of publicly traded companies, 38% of all employees, and 82% of research and development spending. So needless to say, venture-backed companies are extremely important to our economy and to public stock exchanges like the New York Stock Exchange, like the NASDAQ. So, venture capital plays a very important role. Want to call out that 82% of R&D spending. So the venture-backed companies that eventually go public are still some of the most innovative companies out there. It's in their blood. It's in their DNA. So very important to our economy. Very quickly, some of you may be familiar with private equity. So what's the difference between venture capital and private equity? Both are forms of private capital. They operate in the private capital marketplace as opposed, again, to the public marketplaces, public equity marketplaces like stock exchanges. Venture capital firms look at investing in high potential early stage ventures that are kind of pre-scale, sometimes pre-revenue, whereas private equity firms are often focused more on targeting mature companies that are undervalued, that are distressed, or maybe require some growth capital to continue their upward trajectory. Deal structure: venture capital historically has been minority equity stakes and convertible debt that becomes equity at a later date. But recently we see a lot of venture capital deals taking a majority of early stage ventures and startups, which historically has been more of a private equity strategy, which takes majority stakes typically via equity investment, preferred stock, or sometimes mezzanine debt. They use leveraged buyouts, earnouts, and many other models. Some of these private equity deals are extremely complex, whereas venture deals have tended historically, again, to be simpler with lower check sizes, and sometimes longer holding periods, although the holding periods of most venture firms are being pushed down. And in private equity, we're actually seeing a lot of private equity firms that have slightly longer holding periods, and this is mainly because of the influence or emergence of family offices. Family office money into private equity, and family offices care more about generating multi-generational wealth, so they have a little more patient capital there. Venture funds tend to want to exit through a sale of the company, and so do private equity funds. But it's a lot of times those companies will IPO. The IPO among startups, among venture-backed startups, is a little less popular today. Both of them operate on what is called a 2 and 20 model. Which is that a venture fund or private equity fund manager will take 2% in management fees and 20% in what's called carried interest, which is essentially the profits from the fund. So the models and structuring of these funds, whether it's venture or private equity, are very similar, even though they're the companies that they focus on acquiring or investing in are a little different. So comparing returns between venture funds and private equity funds, you can see here on the left that it's kind of oscillated over time, but in kind of recent years, venture funds have tended to outperform private equity funds. And on the right here, this is public market equivalent, is what PME stands for. And this is private equity and venture capital performance pegged to public markets or the stock exchanges. And you can see that the VC, that's the black line, has also outperformed versus the public markets as well, whereas PE actually was on a downward trajectory relative to the public markets there. So venture has a lot to offer for private capital investors. Quick historical aside, I think history is important. Equity, we've been talking a little bit about private equity and venture capital. They're both forms of private, that is non-publicly traded equity investment typically. And equity represents the ownership interest in the company. It is essentially the value that is owed to an equity holder on a proportional basis after you subtract the company's liabilities. It's essentially the store of value in a company, and equity represents your ownership in that value. Interestingly, many ancient philosophers, including Plato and Aristotle, actually debated the merits of private ownership. Plato thought that private property really undermined the common good by making people selfish and pitting them against each other, whereas Aristotle thought that it actually fostered prudence and responsibility because you had something that you owned that you were now responsible for and you had to take care of. And in the West, private property really emerges as a legal concept in the 16th century with disputes around the ownership of farmland, and then gets solidified into the social economics or the economic theory of the day with John Locke, who some of you may be familiar with, but his work was extremely influential, on the founding fathers and the formation of this country. And Locke thought that property was a natural right, that if you worked the land, and of course back then it was all about the land, if you worked the land, you had an ownership claim to the fruits of that land. So venture capital today, that was yesterday, that was history. Where is it today? And these are contributions and distributions over time, and we can see that the distributions of venture capital have trended upward through kind of 2014, 2015, and then dipped downward towards the latter half of the decade, and the contributions mirror that slightly. Now, you have to keep in mind with venture capital data, there is a lag on the data because some funds haven't closed out yet. So in private capital, you have what you call vintages. So a fund, or venture fund, a private equity fund, the year that it is incepted is its vintage. And then those funds deploy that capital to startups and small businesses. In the case of venture funds, they deploy that capital by investing in startups and small businesses. But it may take them 4, 5, 6, 7, 8, 10 years to exit those businesses or sell their ownership stakes in those businesses. And so sometimes it's unclear how well a fund is performing. If I have a fund of 5 companies and 4 fail in year 1, but the 5th one is Facebook or Uber or a company that does extremely well and makes us tons of money, well, then my fund performance across several years could still be phenomenal, even though the majority of my portfolio failed. So that's why it's hard to track venture capital data. So unfortunately, through this webinar format, I can't take any questions, but anyone feel free to reach out to me via email, rtonar@thecannon.com. If you have any questions on any of this material, happy to answer it. So wanted to talk about the regulatory environment here. And again, not a lawyer, have to be a lawyer to provide legal advice. This is not legal advice. It's simply reporting on information that is already publicly available. But the regulatory issues surrounding investing in startups and using and deploying and fundraising venture capital are extremely important. A lot of startups and small business owners get themselves into trouble because they don't actually understand the legalities around all of these types of funding. So first, securities are regulated by the SEC, Securities and Exchange Commission. They're the agency tasked with enforcing federal securities law. So they regulate everybody from the stock exchanges to private capital investments to self-regulatory organizations like FINRA and FASB, which oversee investment advisors and accountants respectively. And interestingly, until the Dodd-Frank Act in 2010, after the recession, private capital markets were largely unregulated. But that changes, and we'll talk about that in a second. So typically, companies that are fundraising or offering securities or shares or units of ownership in their company have to register with the SEC because you're issuing securities. And anyone that issues securities typically has to register with the Securities and Exchange Commission. Now, why do you want to avoid registration? And there are a number of ways that startups and venture capital firms avoid registration. Small businesses avoid registering with the SEC all the time. But why do you want to avoid registration? So one, for registered investment advisors, right? If you're an individual, you first have to be sponsored by an existing FINRA registered investment advisory firm. And then there's almost 7 hours of exams you have to take. You have to file the SEC Form ADV, which is over 100 pages. And then you have ongoing filings and reporting requirements, and you're publicly searchable and accountable as a registered investment advisor if you're an individual. So that's something that venture capitalists have to worry about. If you're a small business owner, that's less relevant to you. But what is relevant is if you offer securities or shares or units or an ownership percentage in your company publicly, historically that has been considered a public offering. And if you're offering securities to the public, you have to file SEC Form S1, which is 200 pages. And the SEC itself has estimated that the burden of creating or filling out this S1 form is almost 1,000 hours on average, which is astronomical. Who wants to spend 1,000 hours filling out a form? Now, keep in mind that includes a lot of large companies, multi-billion-dollar companies that go public. They have to fill out those forms, so that number is a little skewed. But regardless, there's a heavy reporting burden anytime you have to deal with the SEC. So optimally, startups, small businesses don't want to deal with the SEC at all. So there's a number of laws that help startups and small businesses avoid having to deal with the SEC. The Jobs Act, which was passed in 2012, does a lot in this regard. This is what enabled regulation crowdfunding or equity crowdfunding. So you've all heard of like Kickstarter and Indiegogo. Well, those are platforms where you donate money to organizations or companies, right? But you're not getting ownership in those companies. With the Jobs Act, it allows people to actually invest in companies and small businesses and take an ownership interest in those companies. So it's not a donation, it's a true investment, and you get a piece of the pie. And so that was one of the things the Jobs Act did that's very relevant for startups and small businesses. Now, some people thought or think that the Jobs Act actually helped democratize venture capital, and in many ways that is true. It opens up the opportunity to invest in small businesses to pretty much anybody. Before the Jobs Act, you had to be an accredited investor, and I'll talk about that in a second. But the issue with the Jobs Act is that it only allows for direct investments from non-accredited investors or anybody really. But unaccredited investors who cannot invest in large venture capital funds still can't invest in funds under the Jobs Act, and so what that means is that professionally managed funds that the ultra wealthy take advantage of are still not accessible for most people. Second, because of the restrictions that come with the Jobs Act, the Act actually restricts most people from making more than one meaningful investment a year, so you can't diversify. Well, who ever heard of putting all your money in one stock? You don't do that. You want to diversify your portfolio. When it comes to private capital investment or venture capital investment that's enabled by the Jobs Act, well, the Act doesn't allow people investing in small businesses to diversify like they should be able to. And then finally, equity crowdfunding portals still have to be registered with the SEC. So innovation is limited because there's still a regulatory and reporting burden. So I want to go back to this accredited investor thing because this is really important. So an accredited investor, you'll understand in a few slides why this is important for small businesses. So an accredited investor is an individual or married couple that meets the following criteria. The net worth of an individual must be at least $1 million, excluding the value of the primary residence, alone or with their spouse. So you have to have $1 million net worth minimum to be considered an accredited investor by the SEC, or you have to have an income of $200,000 a year for 3 years, or $300,000 with a spouse. So why is this important? Well, this is important because it essentially means that only people who have this level of wealth or income are allowed by the SEC to invest in private securities. So to acquire or invest in a percentage of your friend's small business, you have to be accredited. I'll come back to that in a second because it has implications for friends and family rounds and raising money from relatives and friends. Another major issue that we see with small businesses is broker-dealer registration. So your Uncle Joe comes to you and says, hey, I can help you raise money, and let me go out and help you find investors, and let me tell them that this is a great opportunity for them to invest in your small business, and I'll help figure out how much they should invest and what they're going to pay for shares in your company. So unless your uncle has a broker-dealer license, they are violating SEC regulations. So the SEC requires that a broker, who is any person engaged in the business of effecting transactions and securities for others, must be registered as such. Dealers are a little different, less relevant for small businesses in this context, but those are people who are engaged in buying and selling securities for their own account or through a broker. But brokers are of biggest concern to us in this context. So if you participate in you or anybody else, if you participate in the solicitation, negotiation, or the transaction or the exchange of securities, you are acting as a broker. If you receive compensation dependent upon or related to the outcome of the size of a transaction or the size of a deal or the outcome of a deal, you're acting as a broker. So, your Uncle Joe says, hey, I'm going to help you raise this money, but you don't have to give me anything unless I can raise the money for you. And if I raise the money for you, I want 2% of whatever I raise. Well, in order to do that, your Uncle Joe has to have a broker-dealer license. If you effect or facilitate securities transactions or handle the securities or funds of others in connection with securities transactions, you have to have a broker-dealer license. So we see a lot of times, friends, family, etc., even consultants come to small businesses and charge them money to help those small businesses raise money or solicit investment. And unless you're careful, unless you're able to pass the finder's test, which is to say you're not doing anything but connecting people, you're not taking any compensation that's related to the success of your efforts. If you're not doing any of that, you're a finder. But otherwise, you're a broker, and you have to be licensed to do that. And there could be repercussions down the road. The SEC can come, and your investors can call back their money, etc. You could even, be faced with heavy penalties or prevented from ever working in securities markets again, or having an executive position at a company, etc. So there are heavy penalties for breaking these laws. And we see them broken actually all the time. So we'll talk a little bit more about the pitfalls of investing in something when you're not an accredited investor in a little bit here as we enter this next section on the sources of startup capital. So where does startup capital come from? Here are the common sources of startup capital. The conversion to PowerPoint on this slide has shifted some of the text around a little bit, but you get the point here that there are a number of different sources that span the life cycle of startups and early stage companies, from idea stage to formation, development, from go-to-market all the way through scaling up. And then, they also invest at different levels. So on the bottom here, on the bottom left, you have founder funded, right? That's still the largest portion of companies are funded by their founders. That's you taking your savings or your retirement money and investing in your own company. Typically, most people can't devote a lot of money to starting their companies, but that's the majority of companies still, and that happens at a very early stage. And then after that, you might go out to friends and family. At some point, you might get conventional financing or a bank loan. That's that conventional lender piece. You might enter an accelerator, a startup accelerator that aims to provide you with not only capital, but also advice and support and mentors, etc. Angel investors who are wealthy individuals. SBICs, we'll talk about those. That's a government program. Institutional grants, grant money for R&D heavy small businesses and startups is out there. Also, if you're a nonprofit, grants will be a huge source of income for you. Venture funds, which provide a larger amount of money, but typically want to see a little bit of traction, or a little bit of proof that you have a good idea and you have a team and you're moving forward. And then CVCs, those are corporate venture capital groups. Those are the investment arms of major companies. And then finally, SFOs, or single family offices. These are investment offices of ultra high net worth families that have very recently started investing heavily in early stage companies. So those are the typical sources of venture capital that we see out there. Now, I've heard it said that revenue is the cheapest form of venture capital. In my years in New York, I never heard anybody say that, but I've heard a number of people say that in Texas. And what they mean by that is that rather than go out and find outside sources of funding, just try to focus on your business and generate revenue, and your revenue will fund your business. I don't like this phrase because it is impossible for even the richest people in the world to self-fund big ideas. For example, if you're building a fusion reactor, there's no way one person can self-fund that. And so for big ideas, revenue is often impossible without outside funding. And secondly, it assumes that the entrepreneur has even a modest amount of money to seed their company or to fund their company at the beginning, which suggests that entrepreneurship is only for people with money already, which of course is not the case. And so I reject this idea that, hey, you should be able to generate revenue without any outside funding. Some people need outside funding, whether it's because they don't have funding on their own, or whether it's because their idea is just so expensive they need outside funding and nobody can fund it on their own. Either way, any entrepreneur, no matter what their background, can have a fantastic, valid, lucrative, viable, sustainable, scalable, and sellable idea. And no entrepreneur, no matter their background, should be locked out of the promise of owning and building a company and all of the fruits that come with it because they don't have money to start with. And that is the role of venture capital, and that is why it is important. That's the role of early stage financing of any kind, and that's why it's important for entrepreneurs. So the founder-funded startups, this is, the oldest form, oldest source of capital, and still, despite the boom in the venture capital and everything that's happening in Silicon Valley and elsewhere, founder-funded startups are still the most common. It's still the most common form of funding for early-stage companies. So now, friends and family. And remember that in order to invest in a company or to acquire equity via securities, which is shares, or if you have an LLC, sometimes you'll see membership units, which is equivalent to a % of ownership in your company. In order to invest in those or acquire those securities or those shares in a company, you have to be an accredited investor. So most small businesses and startups that do friends and family rounds and raise 5, 6, 10K from their mom and their cousins, etc. Unless your family members or your friends qualify as accredited investors, they are actually violating, and you are actually violating SEC regulations on who can invest in these types of opportunities. Now, there are exemptions and there are workarounds and all of that stuff, but in many cases, friends and family rounds are actually in violation of federal regulation. So this is just something to keep in mind. There are consequences for it. just be careful who you're raising money from. Be aware of the regulations involved. Consult your legal counsel, and just keep in mind that anytime that there are shares or ownership percentages of companies, no matter their size, whether small or large, changing hands, the SEC probably has regulation around it. So accelerators are platforms, organizations that oftentimes will invest small amounts, 50, 100, $200,000 in startups and then put them through an educational program with mentors and different activities, etc., to help put them on a path towards success or accelerate their growth, hence accelerators. As you see on the right, the number of accelerators in the US has exploded. They're very popular. There's tons now. In Houston alone, a few years ago, there were none. Now there's 10. So the growth in accelerators has been rapid. And a lot of these accelerators like entrepreneurs to think that they are in it for the best interests of the entrepreneur, which is not always true. In some cases, it is true. Mass Challenge, for example, is a nonprofit accelerator. They don't take equity. But other accelerators that do invest and do take equity have portfolios. They have all the portfolios of the companies that they've invested in, and so they are always going to want to choose the highest quality, most promising, most scalable companies, because that's ultimately how they're going to make money, is by investing in those companies. So accelerators are great. Not all accelerators are equal. Some are better than others, but not all of them are altruistic. Some of them absolutely want to make money. So angel investors, these are your high net worth individuals who invest in companies. They're very important for small businesses. Their average check size today is around $30K. And the vast majority of angel investors that are writing larger check sizes were at one point entrepreneurs themselves, right? So they're entrepreneurs, they become successful, and they turn around and they want to help other entrepreneurs. Interestingly, although women only comprise 22% of angel investors, which isn't a lot, that's significantly higher than the number of women who work at venture capital firms, which is less than 10%. So there are more women angels out there than women venture capitalists working at VC firms. Angels also skew older and well-educated. 62% are between 51 and 70. Nearly 73% have a graduate degree. So they're a little older. They're well-educated. They're probably successful in their careers. Maybe they've had a startup or a small business themselves that they exited or became really successful running, and now they want to help others who are perhaps younger than them or in the same position that they were at one point. So angels are really important, and they're a great source of early stage capital for startups and small businesses. So SBICs, these are small business investment companies. They are private companies that bridge the gap between self-financing and venture capital firms, for example. The interesting thing about SBICs is they're actually regulated and licensed by the Small Business Administration, which typically will match the investment that the SBIC company is making in a startup with a matching amount in small business loans from the SBA. So this sounds like a good deal, right? A private investor puts money into you, and then you get a loan for that same amount, okay? But the caveat is that there are a lot of restrictions on this because the government is involved. They can actually restrict how you operate or even take control of your business for up to 7 years. The SBIC can. If your performance is lagging, and the government allows that because, again, it's a way of protecting the government's investment through that SBA loan in your company. So could be a good option for some, but also comes with some pretty stringent restrictions. So venture funds. Venture funds deploy a lot of the big checks to really promising startups that you read about in the Wall Street Journal that are coming out of New York and Silicon Valley and Denver and other hot startup hubs in the country. The amount of venture capital being deployed goes through booms and busts. today, and I'll talk about this towards the end of the presentation, today there is a decreasing amount of venture capital actually in terms of the number of deals VC firms are investing in, but the size of those deals is going up. So basically, venture capital firms are making fewer investments, but the investments they are making, they're putting more money into. Grants, great if you can get them. There's no such thing as free money, but grants, you don't have to pay them back. They don't take equity in your company, but you often will have to report on your progress because the grant is given to you or awarded to you or your small business for a specific purpose. For example, if you have a small business that is, helping underprivileged kids get a better education, that might be grant worthy, but the grant donor, the foundation or the government entity or whoever it may be, will probably want to see some proof that your methods are actually having positive outcomes. So the government, for research and development, mostly technology, but not entirely, has two really popular programs, SBIR and STTR. The graph on the right is the number of applicants to awardees of these two grants, the SBIR and STTR grants. And as you can see, there are significantly more applicants than awardees. So grant money is great if you can get it, but for a lot of grants, whether they're government grants or grants issued by large foundations like the Bill and Melinda Gates Foundation, for example, often very hard to get. Corporate venture capital is a great option if you are in an industry where this is a good fit. Corporate venture capital intends to create strategic value for the parent company in many cases instead of generating financial gain. So large Fortune 100 might invest in your company because they think your small business is the future of retail, right? So let's say you have a small clothing boutique, for example, and you have really novel or innovative methods of customer service or customer experience. A larger retail may invest in you because they want to see how your company develops and maybe even incorporate some of your methods into what they're doing, right? It helps their business, their existing business. And corporate venture capital is great because they can write big check sizes oftentimes, and they also have a lot of experience, experts, advice, connections. They can be a customer, so they can add a lot of value and bring a lot of additional value to the table beyond their checks, beyond their money. In many cases, you'll see that a corporate venture group cares less about a startup's financial potential and more about its potential for strategic alignment. So again, if you have a small clothing boutique, this corporate venture group, for example, might not care what your year-over-year financial projections are for the next 3 years because they know that by investing in you, they'll be able to connect you with a bunch of other groups in different places, and your financials will no longer be accurate. You could grow much faster with them than without them. So they're more concerned about, do you have something that is valuable to their existing company, their existing business lines? That's what they really care about. And then finally, single family offices. As I mentioned, these are private wealth management firms serving only one high net worth family. Multifamily offices where a capital management or investment management firm serves multiple different families are actually illegal. Under the law currently, only one single family offices can only serve one family. They have investments typically across asset classes. So they might be investing in art or antique cars or the public markets, currencies, etc., land, real estate, commodities, cattle. They might be investing in a lot of things, but lately the amount of money that family offices are directing at venture capital has been increasing, which is a great thing. These families control a tremendous amount of the country's wealth on a relative basis. So it's good to see that they're starting to invest in smaller entities and smaller stage companies. So moving into the next section here on funding instruments, Also, just a very quick aside, I did not in that last section mention conventional financing or bank debt. There's a lot of other resources out there. You may have already had courses or seminars on bank debt, bank financing, conventional financing. So I've left that out of here. There's a lot of resources for that. Some of you may know more than I do about bank financing, actually. So I've tried to focus only on alternative investment channels. So moving from those sources into this section on funding instruments. So there's a lot of different types of instruments that early stage and small business investors will use. You might have equity-based deals. You might have revenue-based financing is something that's increasingly popular. There's a lot of different approaches that investors take. They all have different, risk and reward ratios, depending on what that investor's tolerance for risk is. So the most popular way of investing in small businesses and startups is through preferred equity or preferred stock. So preferred equity requires a valuation to price. So basically, this is where an investor takes direct shares, direct equity, a direct percentage in your company. But how do they know how much to pay you for what percentage? This is where it gets tricky because there has to be a valuation put on your company, right? So how much is your company worth so that I know how much my investment, if I want to get 10% of your company, should be. So to do that, there needs to be a value on your company, which is both an art and a science, placing a value on these companies. But preferred stock in venture capital, at least, is often a minority interest. So they have a minority or percentage of your company and leave the majority to you. It's your business. You founded it. You have the vision. You're putting in the hard work. Now, I will say that lately we've seen a lot more venture capitalists and angel investors wanting larger portions of the pie. And again, it's just all about what type of risk is that investor willing to bear. Preferred stock can be structured in many, many different ways. Almost all kind of Series A and beyond venture capital equity deals are executed using preferred stock. Some of you may also have heard of mezzanine debt. Mezzanine debt is a debt form rather than an equity form of investment, but the structure of mezzanine debt looks a lot like preferred debt, which is that if you have the preferred shares, yes, you will be paid back first, but your upside will also be capped. So whereas if you had common stock, the upside potential is potentially unlimited. It goes up as far as your company can be valued. But with preferred shares, you're kind of guaranteed a return, but that return will be much lower. So a lot of times you'll see at some point preferred shareholders convert their shares into common stock so that they can get more upside. There's a lot of different types of preferred stock and a lot of different terms that people put on it. I'll let you pause here and read through these if you're interested, but there's a lot more that can be said about the types of preferred stock out there. Same thing with the preferred rights of preferred shareholders. That preferred stock, since it is preferred, comes with certain rights and options that other shareholders and other people who own percentages of your company might not have. There's different agreements and terms that you'll have to have if you're entering into one of these preferred share or preferred stock agreements. The term sheet is a major one. This is a document that basically bullet points out what you're offering, right? What's the price going to be? What does the investor have a right to? What are, how much are they willing to put in, etc. So basically just a high-level summary of your agreement. Then there's the stock purchase agreement, which is a more formal document that actually has legally binding force. And then, investor rights agreement, amended corporate documents, etc., to bring everything up to date. but that term sheet and the stock purchase agreement, which can take many forms, are very important if you're raising money, and your lawyer will help. So sometimes you'll hear the terms seed round, Series A, Series B, Series C round, and those terms refer to the specific classes of shares that come into play depending on kind of what stage a company or a startup is in its life cycle. And the important thing to note here is that, as one might expect, the rights or the privileges given to investors decline as the company grows, right? So early stage investors are taking more risks, so they have more preference, more rights, more options with their investment, whereas later stage investors are taking fewer risks because you've been established, you have revenue, you're operating, etc., you have traction, so their rights are not going to be as numerous. And so each of these different rounds, Series A, Series B, Series C, etc., come with a different set of terms that become more friendly to the startup as time goes on and as risk is mitigated. So there's another instrument out there that's called convertible debt. And convertible debt is really popular for early stage companies because it doesn't require that you put a valuation on your company. So remember before with preferred shares or preferred stock or preferred units, there has to be a valuation on the company in order to let the investor know how much they'll need to pay for X% of your company. Now, if you're a small business and you're just starting out, how should you know or anyone else know how much you're worth, right? It's an early stage business. It could be worth nothing. It could be worth millions. It's really impossible to figure out with any objective certitude. So what people do instead is they will invest through convertible debt. So a convertible note is a debt note that converts into equity whenever your company is in fact valued. So once your company has a valuation on it, typically that happens with the next round of financing, or a Series A or Series B round of financing, where a larger group comes in and says, hey, we're going to take 10% of your company or 30% of your company for X 100,000 or X million. Well, if 30% equals X million, you can calculate what 100% of your company is worth. And then that helps determine the holder of this convertible debt what their investment will convert into in terms of number of shares. So the important thing to remember about convertible debt is that it is actually debt. So there is an interest rate involved, and if their note does not convert into equity at some point, they can actually call the debt, and you'll have to start repaying the debt plus the principal on that debt plus interest per the interest rate in the convertible debt agreement. Convertible debt is really important, particularly at this moment in time, given the coronavirus pandemic. A lot of investors are going to be thinking more about using debt as an instrument. It provides a little risk mitigation because rather than just buying shares of your company, and if your company goes under, all their money is lost, with convertible debt, you owe them money. And so convertible debt is a good way to provide early stage investors with a risk mitigated way to invest in your organization. Another form of early stage financing is revenue-based financing, and it's sometimes called royalty-based financing, but this really came out of the oil industry actually in the 90s, but really became in the 1900s, I'm sorry, but became popular in the 80s and 90s among startups. And revenue-based financing is not really debt, but it does come with covenants, liabilities, payment obligations, much like loans or debt. And what it is very much what the name implies, which is you owe a portion of your revenue to the organization or the institution that invested in you. So, Bank X comes in and puts in, a few $100,000 at a certain interest rate. now you owe them maybe 2 to 8% of your revenues every month or every quarter, depending on the time period it's calculated on, until you've paid back that original amount that they provided to your company, plus whatever the interest is. So there's sometimes a 5x multiple on principal. So a 5x multiple on a $10,000 investment results in $50,000 in your total obligation, for example. And those multiples vary depending on who's providing the revenue-based financing. But if you think that you just need a little money to get your company off the ground, and then once it's off the ground, you're going to have a really solid revenue stream, really solid cash flows. Revenue financing might be something that you'd be interested in, but just know that you are obligated to pay this money back on a regular basis out of your revenues. The upside, though, before I leave this slide, the upside of revenue-based financing, of course, is that there's no equity involved. So you can keep all the ownership in your company. You don't have to provide any shares or units of your company to outside investors, which for some entrepreneurs is one of their main objectives. Venture debt is another instrument that's often used, another mechanism. It's increasingly popular. It is just private debt, so it's a loan that's not from a bank, but maybe from a private equity group or a venture fund or an individual even. But the interest rates on venture debt are typically pretty high. You can see 8%, but I've seen anywhere from 12 to 25% interest rates on venture debt. And this is why you got to be careful with venture debt lenders, because with a 25% interest rate, I mean, that eats into your margin. That's a lot of interest to be paying out on a regular basis. So with these high types of interest rates, venture debt can be very risky for a startup. It's becoming increasingly popular because it's plentiful. If I'm an investor and I know I'm going to get 10% interest or 15% interest, well, that's pretty compelling to me as the investor. Not so compelling for the startup though. So just be careful with venture debt. The good news is that because of the low rate environment we're in and we're entering on a national level, conventional finance and conventional debt via banking institutions will be pretty cheap and carry low interest rates. Another relatively new mechanism for early stage investment is equity crowdfunding. We talked about equity crowdfunding already earlier on when we were talking about the Jobs Act, which was passed in 2012. The Jobs Act essentially authorizes or legalizes equity crowdfunding. The equity crowdfunding platforms, again, have to be registered with the SEC. But once they are, any investor, accredited or unaccredited, so you or your Uncle Joe can go on one of these equity crowdfunding platforms and look up the opportunities available and make small investments, $5,000, $7,000, $10,000 into the local brewery, or someone's idea for a new restaurant chain, etc. So equity crowdfunding is a great option for a lot of small businesses. It can be tricky with certain industries because large venture capital firms typically do not like to invest in startups that have raised money through equity crowdfunding before. It crowds the cap table. There's now a lot of small-time individual investors involved in the startup, and sometimes larger venture firms just don't want to deal with all the complexities involved with that. But on the other hand, it opens up the pool of potential investors for startups, and for certain startups, especially ones that are hyper-local and add value to a specific community but perhaps aren't hugely scalable, equity crowdfunding is a fantastic option. There are restrictions on it, which you can see here, so feel free to pause this slide if you're interested. But at the end, I also have a list of a couple of the local equity crowdfunding platforms. NextSeed is a big one that's based in Houston, has a big Houston presence, and then the Cannon, my organization, is partnered with a group called Let's Launch, which also has one equity crowdfunding platform. And across the country, there are platforms similar to those that are doing quite well. and have a lot of opportunities listed on them currently. So feel free to look them up. Your small business may want to reach out to see if you're a good fit to be listed on one of these platforms if this is the route you choose to take. So I know that was a lot, but now we'll talk about something that's a little bit lighter, and that's the future of venture capital. Where is it going? So a lot of venture capital investors have kind of run away from riskier opportunities. So as I mentioned before, we're seeing fewer deals, but higher value deals. Unsurprisingly, the coasts still dominate venture capital activity. So despite all of the early stage investment and startup activity you hear about here in Houston, the South, which includes all of Texas and Oklahoma and Louisiana, still only comprises, about 7% of the total number of venture deals in the country, but only 3 to 4% of the deal value. So we're not doing huge venture deals down here. Most of those deals still exist on the coast. You can see West Coast and East Coast, their numbers there. And Houston, despite all the activity recently, does not appear very high up on any of the lists of kind of active venture capital cities, unfortunately. So one important thing to remember, you hear a lot about Silicon Valley, Silicon Valley, Silicon Valley. You know, it's the hub of innovation, it's the hub of venture capital, it's the hub of startups. And Houston, some people will say Houston wants to become the next Silicon Valley. Everyone says they want to become the next Silicon Valley. What's important to remember about the Valley is that it didn't emerge overnight or even recently, right? A lot of people associate Silicon Valley with the dot-com boom or new technologies. But the emergence of Silicon Valley and its success is the product of a long series of events. For example, the transcontinental railroad lines terminated in San Francisco, which created the fortunes of people like Leland Stanford, who founded Stanford University. And, you know, of course, the railroads, that's back in the 1800s. And Stanford grew research specialties in signaling and electronics, which at the time they started researching those disciplines were not seen as particularly important. It wasn't until World War II, when military spending went through the roof and poured into Silicon Valley to fund radio and radar and telecom for the war, that kind of the tech boom in Silicon Valley really emerged. A lot of that DoD money went into small companies. Professors and students left Stanford and started companies that were funded by the federal government for the war, and those companies eventually took in a lot of the GIs coming back from the war who were put to college with the GI Bill through college, and then, you know, stayed in San Francisco and worked for these companies that now were well endowed because of the Department of Defense funding during the war. So, you know, for all of these reasons, which took place over, you know, many decades, 1800s through World War II, all these events set Silicon Valley up for success. So becoming a hub for innovation and small business growth and startup growth and venture capital growth does not happen overnight. I think people just need to remember that as we evaluate what's happening here in Houston. So the shift in what venture capitalists are looking to invest in and what risk profiles they're willing to accept has also meant a decline in angel investing and a decline in investments in early stage companies, unfortunately. So that's just another trend we're seeing. But on the other hand, there's an emergence of relatively new models like search funds, and a search fund is an investment vehicle where an entrepreneur raises venture funds to acquire a startup that they want to manage and operate. So if you think that you're a great operator and you see a company that you want to acquire, you can use one of these search fund models, go and find an investor willing to support you, acquire a startup that already exists, and operate it. So that's an increasingly popular model we see as well, and one that many entrepreneurs who have operational chops and talents might want to explore. Interestingly, there's also software fatigue. as well as a growing interest in healthcare. So, you think about venture capital and you think software companies, but recently we've been seeing that software venture investment has been tapering off. Healthcare investment is on the rise. Other industries have remained steady. All of this said, there is venture investing, early stage capital for startups and small businesses in any industry, working on any idea. I've seen some really silly things get funded, and I've seen some things that most people thought were silly get funded that turned out to be hugely successful. So whatever you're working on, whatever your idea, there is definitely funding out there for it. Sometimes it's hard to find, and it's harder to find for some ideas and some types of companies than others. But it definitely is out there, especially if you're willing to consider a broad variety of different sources and different mechanisms and instruments, as well as reach out beyond the Houston area to look for funding. Corporate venture capital has been hugely beneficial to the overall growth in venture capital. For a few years, CVC was the main channel for venture capital investment. So it's good to see some of the larger companies in the country reinvesting in younger companies. But corporate venture activity is now starting to taper off. They've invested a tremendous amount of money over the last number of years, and now they're kind of stepping back to evaluate what's in their current portfolios. Really great trend here. Female-founded companies, and I don't think I have a chart in here on minority companies, but minority-founded companies as well are finally attracting more investment. So if you're a female founder, if you're a minority founder, the environment for raising capital has never been better. And so if you're in that category, I encourage you to take advantage of the tremendous excitement around female and minority founders that are out there. A lot of investors are realizing that for too long, people with great ideas, with real drive and real vision, were not being given the shot that they deserve, simply because of how venture capital evolved and where it evolved, etc. But now finally that is changing. So if you're in these categories, now's a great time for you. Finally, just to wrap up here, just some best practices and additional resources if you are looking to fundraise from any of these types of sources. So fundraising best practices: when soliciting investors, know your audience, right? Research them, know their portfolio, understand why they're investing and what they invest in, know about some of their success stories, and research and stalk on LinkedIn and other places the individuals you're speaking with, so you really know what their concerns are. Multiple attestation is really important. So when you reach out to investors, find as many ways as possible to raise awareness and boost your credibility. So if you have really credible friends who would be taken seriously by the investors you're reaching out to, have them reach out to the investors and vouch for you on your behalf. If you can get in the press, and this gets me to the third bullet here, publicity and momentum. If you can get some press coverage, that helps as well. Just makes you look more credible, more legitimate, and it provides multiple sources for investors to evaluate, rather than just you talking about your company. Of course, you're going to say that your small business or your idea, your startup is great, right? It's yours. But if other people are saying it's great too, that de-risks the deal for investors. So try to do that if you can. Persistence. Look, there's a balance between you'll have to get a restraining order and I don't want to bother you, right? You don't want to be so standoffish that you never get a hold of people, but you also don't want to harass them and show up at their door on the weekends. There is a middle ground. The other thing I'll say is a lot of investors receive hundreds of pitches and unsolicited emails every week. And many times your email just may have gotten lost. It may have gotten buried. It may not have even gotten read. So don't be afraid to email again. Give it some time, then email again. And again, if you can find someone else to email on your behalf, use LinkedIn, etc. just keep at it. Persistence is important. Be tactful and try to get other people to help you out. Use multiple methods: email, LinkedIn, phone, etc. And then make your own luck, right? Serendipity can, to some degree, be manufactured by taking risks, showing up, and by getting out there. Obviously, this could never happen in Houston where everyone drives, but when I was in New York, a friend of mine was working for a startup, and my buddy and some of his colleagues were talking about their startup on the subway. A gentleman overheard them, handed them a card. That gentleman represented a firm that ended up investing in my buddy's company. So essentially, they found investment on the subway. Much harder to do in Houston, and that does not happen all the time. You almost never hear stories like that. But the point is that if you get out there, if you expose yourself to new places, new people, and kind of put yourself out there, good things are more likely to happen. Know your material. That's obvious. You got to demonstrate a command of all areas of your business, including your financials, right? There's nothing more debilitating in a pitch or an investment conversation when the startup founder doesn't know their financials. Product market fit is very important. This is the #1 mistake at the Cannon we see startups make. Don't forget, you have to clearly identify who and what the market is, right? Who are you selling to? Why do they want it? Is there a market for it? Is there demand for what you're selling? And you have competitors. So even if you don't have direct competition, you still have substitutionary competition, and you have to make sure to acknowledge that. A lot of people will say, well, we don't have competitors. Well, there's always something that can take the place of what you're offering, even if it's not a direct competitor, right? So silly example, but the pool noodle is a substitutionary competitor for other types of flotation devices, right? So you might say, oh yeah, no one else has this type of flotation device for kids in pools, just like ours. Yeah, but there's others: tubes, pool noodles, life jackets, etc. So just because there's nothing exactly like what you're doing, there's still most often other things that can be used for the same purpose. Those are your competitors. You have more competitors. So when pitching for a fixed pool of money, your competitors are also the companies seeking the same funds. It's the guy or gal who pitched before you. It's the company that's pitching after you, right? So if you go into a pitch and say you have the best idea that these guys have ever seen, just remember that they've seen or listened to dozens of pitches that week, and you don't know what they've seen. So all the people that are pitching for that pool of money are also your competitors. So you have to make sure that you're presenting well, that you're polished, that you know your stuff, because you're competing against other people for their money. It's not Shark Tank. So look, a lot of people, when they're pitching for money the first time, think that they have to have a overproduced presentation where there's crazy lighting and fog machines. Shark Tank is 90% smoke and mirrors. I've advised several startups that have been on Shark Tank. I can tell you that the majority of what happens on Shark Tank takes place off camera. Before they get on the show, there's a tremendous amount of conversations that happen in due diligence, and after the show, there's also a tremendous amount of conversation and due diligence that takes place. And some of the deals you see, quote unquote, get done on Shark Tank don't ever happen because they fall apart after the show is over. So it's a very controlled environment. There's a lot more that goes on. So don't think that in a 2-minute pitch you're going to close the deal with the amazingness of your presentation. There's a lot of details to be worked through. So just don't try too hard. And don't adopt bad habits you see on TV. It can reduce your credibility. And then finally, passion fuels entrepreneurs. Really show you're fueled up, show you're fired up, show you're passionate about your idea, and don't give up that passion. Don't let investors or friends or family or colleagues, etc., try to divert you away from what you're passionate about, right? Because at that point, you might as well just give up. If you're going to try to work on something as an entrepreneur that you're not passionate about, when things are tough, when the money's not coming in, when you're struggling to get customers, I guarantee you are going to be very likely to give up, for a steady paycheck if you do not believe in what you're doing. So you have to believe in yourself. You have to believe in what you're doing, and show that to investors. They want to see people that really believe in their ideas, believe in their businesses, believe in their causes. So make sure that comes through. So some local resources. At the Cannon, we have a great advisor network of local experts that can help you. We have an investor network that can help you as well. NextSeed and Let's Launch are two local equity crowdfunding platforms you might want to check out. The SBA, Tim Jeffcoat, who's the regional director of the SBA, has a great relationship with the SURE program. He's a fantastic guy. Reach out to the SBA. They're a great partner for a lot of companies. And many of the accelerators that have emerged in Houston, Mass Challenge, Plug and Play, Generator, Capital Factory, those are all partners of the Cannon. We love these folks. They're really fantastic at what they do. There's many more. Not all of these programs are right for all types of businesses, but if they're right for your business, could be a great fit. So please look them up. And then finally, just the last thought I want to leave you with. Herman Melville, the author of Moby Dick, once wrote that about innovators and explorers, entrepreneurs included. We are the pioneers of the world, the advance guard sent on through the wilderness of untried things. That is the entrepreneur. You all as entrepreneurs are pioneers, and you're blazing the trail that others are not willing to. You're on the front lines of the new and the untried. And that is ultimately what makes America great. Small businesses are the backbone of this country. Startups are the engines of progress in America. And we need more entrepreneurs. We need more small businesses. We need more startups. That's what drives this nation forward. That's what drives capitalism as an economic system forward. So I just want to congratulate everybody on all the hard work you've put into your efforts in startups and small businesses to date. And the Cannon and the SURE program and all of our allies in the greater Houston area are behind you and stand ready to support you. So thank you for your time, and best of luck out there.